Word.
All right.
All right. Hello, everybody. Welcome. It is Tuesday, April 29th. You are here for the Alberts List monthly job search and inflation report update, where news and views can help you with your job hunt or help you understand perhaps why the job search is great or not so great. My name is Albert. I'm the founder of Alberts List, and I'll be your co-host today, along with Colin, who is our moderator for this webinar, and Dr. Reilly White, who is a professor of finance over at the University of New Mexico. He has been here for many, many months now, and if you seek his credentials, I have dropped them here in the webinar chat, and they're also available for you in the YouTube video description after the fact as well. So please scroll down. So as this webinar goes, we spend this next hour and a half speaking to the details of what's been going on in this job market and this economy. And as you know, inflation and tariffs, especially tariffs and Liberation Day, are likely atop many of your minds. So without further ado, I'm going to go ahead and hand it over to Dr. White here. Thank you so much for coming back. It is always good to have this, especially in the most uncertain of times, and we are happy to have you here.
Thank you so much, Albert. Thank you so much, Colin. Thank you so much, dedicated attendees of the Albert's List Economics Showdown, Hoedown, and Jamboree that we're about to host right now. It's incredibly appreciative. I love seeing your comments and networking with each other. Special thanks. Thank you for reaching out to me today on LinkedIn. Andy, Joachim, Ashay, and Megan, thank you so much for making it happen. And thank you guys for being here today. So let's rock and roll. So we got a jobs report in front of us today. And man, is it a showstopper? So with the power of AI technology and in honor of the recent the earthquake in San Francisco 119 years ago. We got this picture that kind of symbolized the job market on the left-hand side. This was just taken. You can see by the cloudless streets and the grime on the buoy. This took place somewhere in Daly City. But fantastic Alberts List performance led by this former computer scientist graduate from Stanford and programmer for Alphabet, now working selling newspapers on the side of the road. And on the right-hand side, of course, looking eerily similar to the 1906 newspaper of the same name. I can't explain it. It just happens. These things come through the door. But we've got a lot to talk about today because it is going to be a ride. But I want you, as always, to ask any questions, do so in the chat window, and I'll happily address them. You can send them directly to us. You can send them to everybody. We'll get a hold of them and we'll answer them. I also received a number of questions to answer in this jobs report, and I'm going to do my best to hit all of them today. Keep me posted with any questions, or if I missed your question, never let me forget, and I will answer it accordingly. Boy, what a day. So let's rock and roll. So we've got this thing, but here's the good news. It starts good and then it gets a little bit testy coming down the list here. So let's see what we can do. So March 2025, that's our most recent jobs report. The results were released earlier this month. How did we do? Well, because we're waiting for the shoe to drop, we haven't really seen the losses that we are anticipating we'll see across certain sectors. We had 228,000 jobs added this month. That's an incredible number, relatively higher than the amount of jobs we've had over the last 12 months. But there are some reasons to be concerned and some seasonal variations to address. First of all, it's still the case that healthcare, again, is hitting those jobs. And those healthcare jobs we'll actually get into on a slide for a question that I received earlier last week, rather. And a little bit of summer hiring for the leisure and hospitality market. That includes hotels, it includes restaurants, it includes other things. But basically, that market is often more of a low wage and often has a very high turnover market. We saw them lose jobs last month, and we saw some gain back here. Now we're just starting to see just a nibble, a flavor, so to speak, of federal government losses, about 4,000 or so. And the information sector, still rocking and rolling. It is not great, about 2K below. Labor force participation rose slightly, about 0.1% to 62.5. So we got about half the sectors in the economy kind of doing relatively badly. About a quarter are doing pretty well. And then you got kind of a mediocre situation in the middle. Now, I'm sorry. Also, I want to apologize to Albert on this one. I did put in Albert's picture and ask him to replicate Albert, and they kind of give you an idea of Albert without actually talking about Albert himself. So let's see what we got here. So anyway, let's look at the economic overview, why you care about it, and the bottom line for where we are today. Boom. Alexandra said earlier today we've got this consumer sentiment is down. Oh, you're not seeing my screen. Is that true? Oh my gosh. How are you guys seeing it? Can you guys not see it? That's really interesting. Any,
Wait, I was seeing it.
were you not seeing it? What do we got?
Yeah.
Okay. Oh, it's
Oh, like
black
you
on
might,
your end. That's so interesting.
like you might want to relaunch your Zoom.
Okay. Whoa. I just had this, you get that as a professor, you're seeing flashbacks and you're just like, can't do this. How did this happen? I've been giving a presentation for 3 hours and there was no slides up there. People are they're just crazy. They're just driving in their cars going, oh, I've got to do this. This is part of my probation, early release program from prison. But anyway, this is great. So anyway, so I love it. I like Albert as Kim Il-sung. No, it's very fun. Uh, okay, picture in picture. Thank you. Good. Hopefully, some of this feedback is helpful, Alexandra. Thank you so much for bringing it to our attention. Hopefully, she'll restart and get back in the swing of things. So I always hate. So keep me posted if something doesn't look right or looks weird. But I changed my monitor size, and that kind of helps with the visualization of the mode. So here's what we got. So all right, so we've got an increased risk of a recession, and as we mentioned earlier, we look at consumer sentiment, and that's fallen most recently a little bit off of a cliff. Now, let's rock and roll about this for 1 second. So there used to be a really tight correlation between consumer sentiment and personal spending. When consumer sentiment is high, people feel good about the economy. They feel good about making purchases, like Colin going out and buying another Bentley for his collection. You have a sense of this of purpose, of that you are financially equipped to handle downside risk in a meaningful way. When consumer sentiment drops, people get more tightened with their purse strings. At the end of the day, this matters significantly because consumer spending is about 69% of the GDP of the US economy. So the amount of money that we spend on stuff drives our economy forward with jobs and everything else. And so this becomes a really, really good time. Aaron, that's hilarious. Thank you. Colin, I can afford a Pinto. A Pinto. It's short for Ferrari. But one of the following things, as you look at consumer sentiment, is that this sort of has been a little bit different in the last couple years since COVID. COVID was a huge shock to consumer sentiment. And although we came roaring back in the economy in the following coming years, we didn't see consumer sentiment ever recover to that same level. And in fact, we've seen consumer sentiment drop again in 22, 23. It went up in 24, and here it is down again at the near nadir of what we're looking at. Oh, Marcia asked, what's a good statistic to look at for shipping data? So that's actually a really good question to ask, actually. So we look at a lot of things. There's a slew of economic reports that come out, and I'm going to bring in some additional data that we know about the most recent economic reports out there involving industrial production and industrial orders. And so when you think about shipping, you can precede shipping by trying to figure out not just looking at what's physically coming into ports, but looking at international orders, manufacturing orders, industrial orders. That gives us a sense of where shipping is going to be. Marine transport moves about 80% of global trade from place to place. It's phenomenally, phenomenally important. And so when you're trying to look at shipping itself, it's often helpful to look at some additional numbers as well. Wait, we've got Colin coming back. Colin, what have you got?
Oh, but I was gonna let you finish first, but
Oh no, keep going. This is good, Colin. I'm just gonna keep talking. But no, continue.
okay. Yeah, I've heard a theory that all of this is deflationary
Mm.
and which will bring prices down in the long run, and therefore this is good. What is your take on that?
So which part being deflationary? Go on, because that's interesting.
Consumer sentiment falling and
Oh yeah.
recession intensifying.
So that's an interesting perspective. So Colin brings up a good notion. So how could this result in deflationary economies? Well, if consumer sentiment drops and people indeed spend less money, that lowers demand. And if demand drops, that could, in theory, reduce prices or it will bring us into a recession, which might level off or stabilize prices. But on the downside side of this, we've got this opposing factor, which is now tariffs, which has the effect of rising prices and creating inflationary pressures on our supply chain. And we'll look into that with some detail. And so what we're doing is looking at consumers potentially dropping off spending and reducing demand, fighting similarly tariffs, which are driving prices higher. And how that equilibrium will shape up depends on the magnitude of both of those things. And so the bottom line is it is possible, Colin. But if we see a drop in consumer spending, which precludes it, we'll be in a recession, which it's like, oh, great, prices are dropping, but you're in a recession, which is an undesirable characteristic to have. And that would force the Fed, of course, to cut rates to stimulate the economy. And barring any other characteristic or inflationary situation, it might be better. And to look at this, and when we think about that, and I want to, because I like this point significantly, consumer sentiment is falling. Policy uncertainty is rising and recession risks are intensifying. GDP growth is currently tracking at 2.8% below the lower than it was in the previous quarter. And the risk of stagflation light is the fear. That's a combination of slow growth and price pressure. So the other effect is, yes, it could be deflationary, but maybe we could end up in a situation where because of tariffs on products increasing prices, you see prices increase, but you also see at the same time growth rates drop. And you don't like to see those things at the same time. Personal consumption is cooling off. Middle and lower income households have been doing it for a while. The real question is what's going to happen to the 10% of households that control 50% of American spending? And we have a significantly higher odds of recession than we did even a couple months ago. Tariffs are going to be a bigger drag, but even if we try to hammer out a trade policy or it's posturing, or if the government is saying, or the Trump government is saying, well, we're going to raise tariffs on everybody, we're going to force them to a deal that's better than workers. I mean, we already have a default tariff rate that's very low across the country. So if we anticipate what the best potential deal that is, that could come out of that looks like, it ends up being close to where we are now. And even then, striking a trade deal takes an average of 13 months to happen. And so we seem to be doing a lot of damage. But the real thing is here, this is the smoke and mirrors magic. The real thing is the effect it's having on the US dollar. Now, the dollar is a fascinating thing. We benefit from the dollar. Here in the United States in 1944, we hosted the Bretton Woods Conference in northern New Hampshire at the Bretton Woods Hotel, which is, if you've seen it, in the White Mountains, majestic, overlooking the tree-filled, hills of northern New Hampshire. And then we invited all these countries from around the world, and we locked the doors and said, guess what, countries? World War II is going to end soon. And what's going to happen? Only one currency is going to be convertible to the US, to gold, and that's going to be the US dollar. You all are going to have to convert to the US dollar and hold dollars so you can buy gold, meaning that gold was the only currency, the dollar, I'm sorry, was the only currency that could buy and sell gold among other commodities. And this set up the Bretton Woods system, which was the gold standard until the early 1970s, when for a bunch of reasons, including that we couldn't support it, the Vietnam War, Great Society spending, we could no longer support that. It dropped. It was dropped, and the world went into what's called a fiat or floating currency phase, where we've been in the last 50 years. But at the same time, commodities like oil, still priced in dollars. Countries like to hold dollars. They maintain dollars. Dollars in that is still the primary, the most transacted currency in international currency regimes by a substantial margin. Colin, take it away. Questions, comments?
Are there any demerits to being the reserve currency of the world?
Good question. So if you're a reserve currency in the world, so on one hand, the good parts about it is it allows us to deficit spend like there's no tomorrow. We can have it. It's very hard to crash us. We're considered virtually default risk free. We're given a lot of leeway to do the kind of stuff that we like to do in this country. Shenanigans. The downside risk is you can look at it in a few ways. It does increase price pressure on dollars in ways that other countries aren't exposed to. So if you're looking at export markets in general, and you look at, and so even when the United States was relatively weaker, those things, our dollar is still relatively strong because so many people buy it. And so that does hamper necessarily domestic manufacturing regimes. But we said that's not so important as long as we have global supply chains. But so returning to that then becomes a real question and a real issue for us to explore. But I love that. I love that question, Colin. What do you think? This is really interesting. What is your take on the dollar situation?
I think so. What you said earlier, which is like being the reserve currency of the world, does mean that it makes it harder for us to be a manufacturing economy. And I
Hmm.
think that might be I guess, not aligned with what the conservative or Republican side of us, the US wants, which is they want to bring manufacturing and those sort of jobs back into the country. So given that it seems like the stated purpose and goals of the Trump administration is to bring manufacturing back and to bring a lot of those I guess jobs back from, China or India or Vietnam. Um, how does that conflate with the fact that we do enjoy a lot of benefits from being the reserve currency of the world? And would that mean it's better, or do
Hmm.
you see the administration targeting a goal of not becoming the reserve currency of the world? Is that a possibility? Where would that lead?
Uh,
And what are the ramifications of doing so?
So before I give away, that's a great question, Colin. Before I give away the chart on the tariff slide, which is one of the most amusing ones ever. So if we approach the question of how do we bring manufacturing jobs to the United States, which is a opinion that is shared by the majority of Americans, the question is who fills those jobs in that capacity and in what jobs are they filling? And the solution that you find quickly when you look at the labor question is it's not going to be actual jobs. It's going to be automation that fills that work, not actual positions in that same way. But if we look at it from the dollar perspective and the dollar strength perspective, and I really have to bend over backwards because as much as I can describe what I think is generally the middle range, it's how I was taught in PhD school and how most economists and finance people work in respects to the nature of the world. The study of economics is really the way of how we decide to move resources around in society, and it's really how the world works. An Econ 101 course would be a basis for everybody around the world to take. But if we look at something in the sense of if you're trying to increase manufacturing employment in the United States, ipso facto, reducing the value of the dollar does that, but at the expense of many other things that you might need. And so we have a globalized supply chain. Many of the goods we import are intermediate goods. And even by reducing the value of the dollar, that reduces our ability to purchase stuff from overseas to go into the stuff that we have to make. And so what it does is it results, and that's not even the tip of the iceberg. We have so much privilege. We have a very extensive, uh, noble privilege that we've been able to enjoy because of the dollar, and we're accelerating international solutions that don't involve the dollar that were already in play. But the resilience of the dollar in the US economy has kept us afloat for the past few decades. But what we're going to do is force people away from using the dollar in those circumstances to our own dilemma. And it has a slew of other issues. And so the benefits of a weaker dollar might be a better manufacturer situation, but the drawbacks are, I would argue, potentially just as severe per se. So that's a really good question. And so I would actually look at imports as being the source of this because right now we don't have that capacity nor workforce able to generate the manufacturing that we say that we'd like to make in this country. And so that becomes an issue. Oh, this is good. I want to get back to a couple of questions. Back to Marcia's question about shipping rates and shipping things. Commodity flow surveys, the Bureau of Transportation Statistics often are good rates at shipping. They have a whole bunch of other data that involves that. BTS.gov is a great source. Data.gov has access to CFS data. Even Census does some stuff about this. Big fan of that type of stuff as well. And so Albert says, what would it take to recalculate our GDP? Oh, I like that. Don't like the numbers. Let's just recalculate what it means. So GDP is actually a pretty basic formula. And the fun part about GDP, and this is actually useful for you, so get your pencils out. I'm going to tell you exactly what that formula is. And so GDP, when you look at gross domestic product, the value of the goods and services produced within the United States, it's nothing more than C, which is what we're consuming, plus I. So C plus I plus G. I is investment. So business spending on things like goods and inventories and stuff. And then G is government spending. And then you're going to subtract our trade deficit, which is the amount that we export minus what we import. So four big things. You got consumption, you got investment, you got government spending, and you've got the trade deficit. And then what happened back in like, would it take to get to the point where something else leads our GDP, like foreign investment? Possibly, but we have kind of the formula has to be this way. And so what does this look like? And what happened with that Albert question? What happened to the GDP estimate that's going on right now? So we were tracking sunshine, rainbows, unicorns until the end of February when the GDP estimate shot negative. And it's remained at that level, incidentally, since then, despite a slew of economic data coming in. And that's kind of the monthly update. And so, but this was due, and my question on this was due. Remember the parts of what make GDP GDP. Consumption, investment, government spending, minus trade deficit. We had the biggest trade deficit on record in the first 2 months of this year because of tariffs. Companies bought a huge amount of stuff from overseas. They imported a lot of stuff and to get ahead of tariffs so they didn't have to pass that on to consumers with higher prices immediately. And so that created a distortion in our GDP estimate. And it's too early to tell whether or not it will continue over the long run. But right now, that's being driven by trade policy, which is amazing. Melanie says, how does the US dollar strength affect countries like Ecuador and Panama, which use it as their own currency? That's absolutely a good question. So when you have a currency or don't have a currency, that's a question of monetary sovereignty. And so when Ecuador chose to adopt the dollar as their currency, they are facing a period of inflation and economic uncertainty. One easy way you can get rid of that is to adopt another country's currency as your currency. Problem solved. Inflation issues? I'm adopting the dollar. But why would a country want to do that? Well, it creates stability. It ties your country's fates to a larger economic entity, which if you're a developing nation might be appealing. But on the downside of that, you're surrendering economic or mere monetary policy to another nation. So if you're Ecuador and you are experiencing a time of joblessness and you want to stimulate the economy, but the United States isn't, you have no means of making that adjustment because you don't control your own currency. You can't flood the market with currency. You can't reduce that. You surrender monetary policy to a foreign partner. And that is the trade-off that you have to deal with in these situations. So both for Ecuador and Panama, whenever they're experiencing an economic issue of great gravitas or issues that's native to their own country, they cannot respond in the way the United States can. Because the United States doesn't care. I mean, we care. We don't. The government has no imperative to act in response to the citizens of Ecuador. And so the Federal Reserve doesn't care. The Treasury doesn't care what happens in Ecuador. And so that becomes an issue, as well as other logistics involving the spread of dollars and other things. That's a great question. Scott says other countries have adopted the US dollar as their own currency, when their home currency has not been as strong. That is the advantage. But again, when you're encountering economic issues, you surrender that. Ba-dum-bum-bum. Now, let's talk a little bit about problems with the economy. So we started with a good jobs report. Yay! Let's continue this magical adventure downhill, up from Rainbow Mountain of jobs report land down into where we're forward looking and what we're concerned about. So the decrease in credit card quality in the United States credit quality has been a big issue. California, the average credit card debt is about $9,000, which is a huge amount for a revolving month-on-month amount with an interest rate that is often 20% or higher, the highest rated interest rate many American consumers have. At the same time, we are spending. The biggest top 10% of earners account for half of all spending. I showed this chart earlier last month, and it is a big deal. But notice that it's coming at the expense of these other income, not quite quintiles, other income divisions that exist in this space. And so it's interesting to see that we've seen personal consumption levels be adjusted or drop even among lower and middle income households, whereas high income households have remained persistent. What happens to these households is incredibly important to decide where the economy is going to go next. And let's talk about this, and let's talk about a few things about economic forecasting in general. And so on the left-hand side, we're tracking Goldman Sachs and Bloomberg, two widely distinguished financial entities. Bloomberg even interviewed me more than once around his couple of economic topics on a very slow news day. The one-year recession odds for Bloomberg. Bloomberg famously in April of 23 saying there's a very high chance of a recession. It did not come to pass. We avoided it, thank goodness. And then Goldman Sachs, a bit more conservative at that time, was only saying about a 35%. Now those percentages are reversed. Bloomberg's trying to be ahead, trying to stay wary of the economy as always, but without the same finesse as it did back in 2023, with a little bit of conservative hesitation in its response because it was wrong in 23, now saying there's a 30% chance of a recession in the next year. Goldman Sachs taking a bold step of saying there's a 45% chance. Moving from Goldman Sachs, we're going to move over to JP Morgan. And this is how they looked at the US economy in a nice little tree format for those of you operations majors out there. So they're fun to look at. So they argue that there's a 60% chance of a recession, with 40% being a global recession. Oh boy, hooray. And a 20% chance of just a US recession, whereas the rest of the world experiences moderate growth. Now, let's say that the US doesn't enter a recession. They say that's about a 40% chance. Of that amount, 25% says we have low growth in that area. Euro area starts improving, but US growth remains low. The Goldilocks situation, where inflation and rates normalize, is only about 10%, and a 3% growth rate, which was still on the table a few months ago, now a 5% chance. Tough schnoogies, US economy, says JP Morgan. Now, how are we doing? Any questions about that? Because we've got some more things. So, Reilly, are you the last person, or are you also reducing your model? What do you think the odds are? And I gave this really, really milquetoast response to a local media station, and they're like, well, I'm not. There's a 50% chance of a recession. Coin flip. When you're not certain, because there's a lot of things that could go wrong, and the policy uncertainty isn't helping us. But on the left-hand side, these are all these different entities that gauged their U.S. economic outlook in 2025. Everything that's red means a downgrade in their economic outlook. And so whereas everybody was kind of hurting around the 2% level, there's a wide variation now between about -1 and +1%. Only a couple of places increased their projections, one of which was First Trust Advisors. And let me check my notes on this one. St. Mary's University in Texas also says we're going to grow at 3% this year because they are crazy pants. But I don't have another solid economic predictor out there that says that this is going to be the case. So Ajay says, if there has been a recession, the A, when time frame we find out that we went through a recession, and B, will we be out of the recession when we find out? A great question. Who determines when a recession is, Ajay? That is the National Bureau of Economic. That's our NBER, which is of economic research. I'm sorry, NBER. So NBER looks at a slew of economic data, and they make a choice, and they make a deliberation that is often months after the fact. A good example, back in 2020 in the COVID pandemic, the recession was the worst in April of 2020. In June 2020, NBER announced there was indeed a recession. Sort of like, interpreting the data, they have to double check and make sure things are dandy. And it has to be a large, widespread economic slowdown that does not merely affect a single sector with significant impact on the job market. Invinita says, what about corporate earnings outside of technology? Don't they have a good outlook for large corporates? That's a very interesting question. So the corporate earnings are going to be the interesting thing to watch in the next year. So right now, there's nothing to suggest that we'll see a change in earnings in the first quarter. I will look to the second quarter and third quarter this year as indicative of what's going to happen in the markets, because we haven't seen those tariff or inflationary regimes come in, companies that maintain inventory for a long period of time, or companies that maintain those operations over a long, or have a longer term inventory or longer term operation strategies, won't see that drawback initially. We'll see those costs pile up down the line in response to certain consumer sentiment. It is the absolute thing to watch, though. And one thing to note is we've seen fewer, whereas 2 years ago, we were looking at a situation where most companies beat their earnings targets. This is now not the case in the economy right now. Colin.
This question just kind of came into my mind, but is there a way to predict how bad it will be? So
Ooh, yes.
on a downbound train is we know we're heading in the wrong direction, but there's, 9 layers of hell. Which layer is it? Are there any economic predictions for which layer we'll end up in? Like,
So, so how bad is the recession going to be, and how will we be able to produce that? That's a really good question. Okay, all right. And I see you on this because you're looking at anticipatory measures, not lagging figures, and you're trying to say, is there a way by just looking at the tea leaves now that I can interpret what it would look like? And so this is very interesting. So a decline in a recession of GDP around 2%, 1.5%, 2.5%, that's normal. When it's more than that, like 3 or 4 or 5, that's severe. Two things happen. One question is the nature, is it a shock or not a shock? Let's say that it's not a shock. It involves a deterioration of the economy that is partially anticipated by trade policy or where we're headed now. That's a factor, but what alleviates recessions or determines their depth is also partially the response to those recessions, as indicated. Is there a quick Fed response? Is there a government stimuli? Is whatever is causing the economy to fail, is that corrected in some way? And so sometimes that's possible and sometimes that's not possible based on different circumstances. And so you have a really good question here. A rapid fall in consumer spending, I would argue, would be a good forecaster of this. So if we see consumer spending info really fall off a cliff, and it's fell off a cliff in a meaningful way, that would drop. Things like corporate profits are good. And then, of course, we look at volatility. Things like credit spreads on the marketplace are also important. I'm just trying to, that's a really good question. And it's partially, you know, we're not even good enough to predict a recession when it happens. And we are terrible at predicting the market. But could we predict how severe something would be? For me, that would depend on the nature of our response to that recession. Because even things as severe as the COVID recession, where you had unemployment rate go to 14% in a shockwave overnight, was again alleviated by 5 trillion in stimulus, which brought about inflation, but got us out of that cycle very quickly and kept it from being a long-lasting recession that destroyed a generation. We were just scarred severely, but not destroyed by that recession. And so that's a really good question. Oh, this is a fun one. Aaron dropping the Fred links in here as well. That's pretty cool. So all employees in trade, transportation, and utilities in Oakland, Fremont, Berkeley. And you can see that is on a downward trajectory since reaching that pre-pandemic high. Very good data, Aaron. I love that one. That's a good one. Check Aaron's links out as well. U.S. recession probability model in the conference board has shot up to about 96% in 2022. And I left this here because it was wrong in August of 2022. And so remember that even when we say the probability is very, very high, it does not necessarily equate that it will happen. So noted. Next on the docket, though, let's talk about the other elephant in the room, which is trade policy. And my favorite chart on the left from the Financial Times. On left, okay. Let me ask you the question. Would America be better off if more Americans worked in manufacturing? And whether you're Democratic or Republican, about 80 to 90% of Americans are like, yes, we need more manufacturing in the United States. Now, on the right-hand side, I would be better off if I worked in a factory. Only about 20% of Americans, regardless of their background, economic, Democratic, or Republican, say so. So where, perchance, are we supposed to get these workers for the factory that we produce in the United States, for the stuff that we buy? People are price dependent and consumer dependent. That leads to one of two possible conclusions. We need a large resource of people, perhaps from other countries, interested in working in our new manufacturing plants that would result in an increase in immigration. Or number two, we automate the sucker and say, well, we brought manufacturing back, but not the people in those jobs. You cannot have both things. And this is the great question in American policy that we have to grapple with today. Now, on the right-hand side, you've got the effective tariff rates across each industry. So before in 2024, and again, across the board, we were not tariff-less. We had tariffs about in very small amounts across the country. The magnitude of tariff increases is what's important to watch here. So in January through March, in the initial rounds of tariffs that were discussed by President Trump, we saw those numbers increase substantially across the board. In the April 9th announcement, the trade war against the world is showing just how drastically significant these numbers actually are. Albert says, We can't want it and not want to do it for ourselves, can we? This is crazy. What do we do? How do we fill this gap? We want manufacturing, but what can we do about it? And I'm not to say, and that is not to say per se, that I expect that it's some kind of zero-sum game where we're going to end up in a situation where it's this or that with manufacturing. It doesn't really work that way in supply chains. The curious point is what we do from a policy standpoint right now to preserve the manufacturing industry that we have, but also try to maintain and grow it based on future needs, not the needs of the past. This is a complex situation. Again, the average trade deal, it takes 13 months to negotiate. And even if they're able to get rid of this overnight for something that's more favorable than workers, it would produce a level that was only marginally better at the best case than what we had in 2024. And that's still very unclear as to what that would mean. Benita says, but haven't we moved away? Indeed. And given that we're globally connected, manufacturing has gone to countries that have better production processes, use of tech, and lower labor costs. We can't go back, right? Benita, you're absolutely right. The only way we could go back in that particular situation, our existing structure of labor laws, resources, connect, as well as the ability. We don't have even the personnel requirements that countries like Taiwan and South Korea have for a very high level of very technical, educated manufacturing finesse. We don't have that workforce here. That will take years or even decades for us to develop. And so as a consequence, I only see the center of this to be fundamentally one of automation, should it happen anyway. And even that case, it does not bring back the jobs we expected. Again, another favorite chart from Joe Politano from this last month is just showing how our tariff rates have increased across our import mix and kind of our projection on what he runs a projection based on the tells about the administration and what they're going to look at next, expecting things like pharma, chips, lumber, copper, electronics to also feature into this as we approach May, but we will see significant increases in potential costs. We have not seen those effects yet. Those won't work their way through the system for months ahead of time at the very earliest. But we have to worry about a few things. I showed this chart last time because people asked about the stock market. We had another question. What's the stock market going to do in the next month or 2 months or 4 to 6 months down the line? I can't tell you what the stock market's going to do tomorrow, and no one really can. But the sentiment index is that the equity sentiment is down. And whether this bounces back or not, we'll still see. I will point out again a chart that I showed last month. If you had a chance to tune in on this, we had this recent data come in from Vanguard, and they look at price to earnings ratios. Price to earnings is a nice forward-looking indicator of stocks that tells you how much bigger prices are relative to earnings per share, what companies actually make. And because PE levels before this correction were really, really high, PE is not a good forecaster of what stocks will do in a year, but they tend to be very useful for a 10-year horizon. And Vanguard came out with a U.S. equity anticipated a 50th percentile U.S. equity projection of just 3.9% on average over the next 10 years, which is climbing Mount Disappointment in terms of equities, because over the last 90 years, we've returned an average of about 10 to 11% in just equities alone. So if 4% is like a lost decade for us in the stock market. And that is what Vanguard within the But we have situations now where manufacturers they don't have or feel like they don't have enough supply of labor to actually fill the jobs that we have presently in manufacturing. And so barring really a government-wide retraining program for manufacturing and what type of manufacturing could we have, this could be difficult to actually maintain. There are things that constrain firm growth, and one of them is expertise. I think my connection might be cutting out, Colin. Can you hear me okay, Colin?
I don't know whose connection was cutting out, but
It's mine. It's mine. It's mine. You missed nothing. I screamed into the universe by myself. I apologize. We have a yes, thank you, Benita. Yeah, I am cutting out. But I have a 3-2. It rains like every 3 or 4 months here, and we have like a slight bit of rain, and that causes the electronics to fry here. Everything's outside. We just keep them outside on the roof. Why is my exposed motherboard up there? I don't know, but we've got this issue, so we're going to figure out what we do with it. So I apologize if I cut out in the meantime as well. So keep me posted, and I'll try to get through this with hopefully not too much issues. Okay, so another issue that we've got cooking on this market. So one of the tells per se that we're in a slightly reduced economic picture is home demand. Home demand is going down substantially for major builders. On the left, these are the earnings press release that we got from D.R. Horton, one of America's largest home builders. And we've got, especially in the Southwest and Southeast, substantial drops in sales orders for new homes, about 20 to 26% lower than where we were. Across the country, about 15% lower in the last year. And that's resulting because of that lower supply, even though that lower supply on the market does create a situation that only encourages housing scarcity. On the right-hand side, we see that Zillow for the next year is actually anticipating a slightly greater than 1% drop, almost 2% drop, 1.7% drop in home prices across the country over the next 2 years. And you'll notice among the featured areas that are expected to lose home prices where they're expected to drop, many places along the South Coast, Austin, about 4%, New Orleans, expected to drop about 7% in the year, and even San Jose expected to go down a comfortable 5% in equity value, making that unreachable home price even slightly less unreachable. And then finally, of course, you've got really anticipatory house drops up here in Eureka, which I found very interesting, and even Santa Rosa clocking in some numbers that are substantially lower. And so that's interesting to note. Now, what has actually happened in the last year, as opposed, this is forward looking, this chart, this map on the right, this is past looking what's going to happen in the last year. And we've actually seen the largest growth areas of home prices. Congratulations, San Jose, California. I'll give you a round of applause. Great job, everybody. Home prices there went up 5% in the last year. Congratulations. Please build more homes. And then all the way down the list, you've got a lot of other East Coast cities. Sacramento breaking even. And then you've gotten places that have built the most, have seen the greatest drop in prices. Places like Tampa, San Antonio, Phoenix, and Austin have seen the biggest downward slices in the last year.
Does this mean those
What do you think, Colin?
I mean, San Jose becoming more expensive, no bueno. But the
But the good
United
news
States on
is,
average getting more expensive. I feel like there's a whole topic that could be discussed here, and it always came down to economists saying the best way to deal with this is to build more houses. And developers keep saying, well, then stop having NIMBYism, and then we have a
yep,
little circle of hell here.
gotta make it easy to build. No one wants to, and the regulations are rough, so nobody wants to build it. Melanie says, why Austin? There's still insurance and barbecue there. Indeed, there's plenty of biscuit for one to get their hands on in Austin. So why are prices going down there? Because they've built the most homes, or one of the highest homes per capita of any large metropolitan area that we've seen. Increased supply means downward pressure on prices when it costs more to buy a home, which is what we've seen in higher interest rate environments. And likewise, places with restrictive supply, or we haven't seen a lot of building, San Jose, saw prices increase about 5%. But even these areas, like San Jose, although yes, up 5%, but yes, also down 5% in the forecast for the next year. So it'll kind of break even, we hope, in the 2-year 2024 to 2026 cycle. So there is an issue. And I mean, I can't reiterate this enough, how much of real estate depends on supply and demand. And in acknowledging Colin's primary point, we're in this circle where developers are like, we develop if we could. We have to see comprehensive zoning reform. California, of course, beset in many ways by inhibitors and legal inhibitors to this sort of development of increased zoning and other things that could potentially increase or reduce the cost of housing. We haven't really seen a metropolitan area seriously look at some of the things that might be done around this issue. Albert says, any correlation between change in home prices and inward-outward migration, job addition or subtraction? There always is. Seems like the places where prices are going down or where people are moving to. And again, Albert, think of it this way. Think of just the magnitudes. And I reiterate this entirely, and I'll say it, I'll scream it from the hills in the hills. People know that they're moving to Austin. Austin has looser building codes, although they're not perfect in Texas. Texas has, Houston, for instance, is given an example of sprawl. They still have parking limitations and lot size restrictions. This isn't exactly, even Texas itself has zoning and other issues, is what I'm saying. But it is easier to build in these places. So they have built. In anticipation of people moving down, they've built a lot. And that supply still eclipses that demand with response to the inflow outflow migration that we've seen. And that's a good point, Albert, too, because it has variable property taxes and other concerns. And when we look at this, it becomes a really, really important issue to consider. But it is also something where these metro areas that have seen the declines in home prices all have one thing in common, and that's they've been able to build a lot of homes in these areas. And that really is the commonality with all of this. And you can have real estate that's affordable if you want to. You just have to figure out a way that you can permit and build in a way that will increase demand. It doesn't work the same way. You're geographically constrained in the Bay Area. You can't just sprawl out into the Central Valley like there's no tomorrow. You have to think about building up, building higher density, building greater, and reducing things like lot size restrictions and reducing things like parking minimums and all this other thing. It's a comprehensive package. And even then, most importantly, you've got to axe that, little legal requirement that allows for environmental review that actually, is the response to many litigious and very expensive lawsuits to maintain for building these properties. And earthquake codes and policy codes and all these things. And so you've got these things and you can do it if you want it, but you have to do it. And in other places where you have this is a fundamental issue in every Anglophone country in the world right now. They're having this issue in Australia, New Zealand, and in Canada, of course. It's ridiculous. It's even more pronounced in Canada, in the UK and other places because of all of these restrictions on housing that don't necessarily exist in other legal restrictions. And so this is true. So it's all true. But you can do it. You can do it with earthquake codes. I mean, you do these things. I tell you, and you can, it's not just in, yes, Japan, of course, declining population, yada, yada, all these other issues. They're able to maintain a much broader stack of affordable housing permits because, of course, you can build, or they have built in areas at high densities that have been very impressive in ways that we can't replicate. Fascinating questions. Yes, good links too, Aaron, as well. Look at the single family. What a depressing link about housing trends in California. I love this so much. Let's look at these housing starts. I'm going to copy this chart and I'm going to paste it right in there to my presentation. I'll do a little live finance from Aaron's link. Annual residential construction starts in California. Great job, California. Since 2008, look at this. Multifamily starts and single family residential starts. You see why home prices continue to be an issue. You need a lot more starts to make that happen. This is crazy. Thank you, Aaron, for that link. So take a gander at this dander. Hold on. Ajay had a question and I lost it. There we go. If San Jose will break even in the next year, does that mean most of the blue metros will go negative from their peaks in the past years per this chart? Not necessarily, Ajay. That depends entirely on local supply, demand, interest, people moving in, moving out, migration, all this stuff. Reform CEQA, absolutely. Make it easier to build. I will scream that. I swear to you, it'll help everybody in the long run. It's more efficient to build up. You can have these things. You too. And I know people are always worried about, I'll live in some Blade Runner-esque skyscraper and it'll be terrible. And, I know. It's one of those things. I'm going to keep starting it. Yes, 1/3 to 1/4 that starts in Austin. Yes, that's right. Aaron points out that there's literally 3 to 4 times as many starts in Austin as all of California. Great. Scott. Build me a home and I'll move to California. No, that's what I'm kidding. I'll get the worst dean job imaginable. I'll move right there. The poor end of the stick. So housing prices are high. And then, of course, we've got other issues in California to worry about, like tariffs on wine. So housing prices are going right now. Right now, on the left, you have the percentage of your income that's used for housing across the country. Guess who's number one? And it's not Arkansas, it's California. 44% of your income in California is being used on housing. Compare of that to anywhere else in the country, even highly dense northeast cities, or whether you're in North Carolina or even in Texas, that is a large percentage and is too much. Next on the docket, on the right hand side, and kind of to switch to kind of ease into my following slide, and actually kind of going back to the question that Marcia asked about import and trade volume. We've seen a fallout in import volumes into the Port of Los Angeles in 2025 versus the previous year. Scheduled imports rose year on year, but then are predicted to drop in the coming weeks. And we've seen that in preliminary shipping data as well. And I want to thank that for that little piece of chart. And I got this data too. Also, I want to thank you for providing this data. I got this. Aaron sent a bunch of links over my way, and I think this might have come from the Pasadena Star. I really Aaron digs up these links from these from California newspapers, and then he sends them to me, and I'm like, these are pretty good. So Aaron, I didn't have time to say thank you, but I appreciate special acknowledgement for Aaron for reading the Pasadena Star, one of the 3 viewers that particular month. So Pasadena Star News. See, I was almost there. Pasadena Star News. You're a Pasadena Star, Aaron. You are the Pasadena Star, I think. Benita says, forget drinking French wines. It's all going to be California. That's the spirit. That's what the importers are hoping for anyway. Or the local, not the importers, but the California producers are looking at. And so I want to kind of bring this around. It is great wine in California. And now, of course, having surpassed, yes, of course, California, the 3rd biggest economy right now in the world. I also got those news. So it's like it is, and I use this term later in there, still the prettiest horse in the glue factory. Good job, California. Now, California also dominates the U.S. unicorn landscape. Right now, consistently leads. And I'm talking about unicorns, not in the blood drinking version or the restoring Lord Voldemort to life version, but looking at the unicorn landscape, startups that are worth $1 billion or more. California consistently leads with 40 to 73% share in these very significant startups in any given year, which is attributable to the infrastructure of venture capital that you have there. And this is and resources and people like you and everyone else who works in those industries. And so we look at California, New York, Massachusetts, Texas, and Washington. You just don't see a drop in dominance. This is prior to 2021, but it's a really, really significant chart. Rarely drops below 40%, and we don't see that follow-up following afterwards. And then if you look at unicorns right now in general versus non-California unicorns, they tend to be bigger. They raise more money. They achieve higher exit value valuations because of the infrastructure of people, resources, and fiscal resources that you have available there. It's a really big deal. So, which makes me ask, go on, Colin, go on, weave me a tale.
Does this mean it's no secret that Texas has been trying to court Silicon Valley companies and starting their own startup scene. Um what is the end goal of what Texas is trying to do? Do we see them succeeding to a measurable extent? And what provisions, because California has historically done a few things that are very good for tech companies to start here, not to mention the mass amount of talent that is in our area and in the chat right now. But it feels like I've been reading that they're not continuing that little trend of making California good for tech companies. A, is that true? And B, um, does the high pricing from the earlier topic of the high housing cost, 40% of housing costs, which definitely contributes to the high salary requirements of Bay Area and California tech workers, does that mean that it's starting to eat into the margins of these tech companies and making them look away from California as a result?
So that is a very important point, Colin. And so I want to address each of those points. So first of all, a good idea in the middle of nowhere is worth nothing. And that's the hard part, right? So you got to bring it to market. You've got to take it on a show. You got to convince someone else it's also a good idea to fund it so you can get a product out, whatever that might be, so you can grow it and make it happen. And so this brings down a couple issues, right? So you have to be in a area with the infrastructure to make that idea happen. Texas is, to your point, attempting to do just that. They're trying to build an ecosystem rival Silicon Valley, and they do that by attracting the startups, attracting the players. But they need the VC firms, they need the other things, and not just the division of the VC firms. They need the full shebang. They need a integrated ecosystem that they have developed in part, but it is nowhere near as deep or as vast as it is in Silicon Valley. Period. That being said, that's why these valuations, the expertise, and the people that we're talking. I mean, this is still the main game. And there's also a bunch of other questions at play. Texas is a different environment. It's a different political environment, a different living environment, a different climatological environment. Texas appeals to different people than California for different reasons. And there are things that you look in each case that become relatively important from a localization spectrum. The benefits going for California, being whether you look at its climate or its situations or the availability of a history of strong intellectual traditions or whatever it is that keeps people there and makes people say, I want to have a family here and have kids here, is going to keep happening. Despite California has succeeded despite this, despite high living costs and everything else. If they made it more livable, that would actually only improve its competitive advantage. But I will say to your point, though, that's not a measurement of complacency because this won't necessarily last forever. If housing is never figured out in California and people keep moving abroad and if it's tax situations or it's other situations or it's the global economy, or even if we somehow poison the world against the US dollar and then startups start happening overseas with great vigor in ways that they're no longer happening in the United States, we're all going to suffer, California and Texas together. And so it becomes a really, really important issue that I think that I would say, don't be complacent. This isn't forever. Texas is trying to replicate this, and they are trying to steal it, but they're not able to do everything as quickly as they want to because of just everything that's been built in and put in place over the last 5, 6, 7 decades in the Bay Area and other parts of California that lead to an infrastructure where I can shop around for best valuations. I've got 10 different VC providers to provide me funding. I can create elaborate stacked equity valuations in a short amount of time involving a great number of real players. And you've got your A-list of programming and tech talent around you that you're not shipping to Texas because they already have a job, that are there because they're looking and hustling for a job. And that's still the specialness of it. But it's not going to last forever if prices aren't fixed and this calculus doesn't change. And the magic that is Silicon Valley will continue to wane if these cost of living issues, if these infrastructure issues, tax, whatever you want to call them, issues aren't addressed. And so it's going to be a gradual and long-term bleed as opposed to something that's going to happen overnight. But it's still something you should put a tourniquet on rather than just let happen. How's that?
Well, if Texas is listening, I can be bought with a house and no property tax.
Not Texas. Colin, no,
Yeah.
everybody.
Give me a
Texas.
house in a good place and no property tax, and you can get my text
No,
request.
true. It's a real deal, though. You can. It's so inexpensive. You can do it.
Yeah.
That's a good question. So Albert says, found a startup while in class at a B school or E school, get space at WeWork for a few years, and then when you hit scale, move to Arizona, Texas, Florida, Nevada. Would Lyft, Uber, Pinterest, Facebook, Twitter, Klarna have had resources to be found at the University of New Mexico? No. Weave me another tale, Albert. No, of course not. No, we did. Microsoft, founded right here in New Mexico in 1976. We then arrested Bill Gates and caused that famous mugshot when we was caught speeding. And then they moved out in 1980 to Washington. So that's the fun story. We're a good place where people have a lot of ideas for tech firms here in New Mexico, and then they go elsewhere and do more fun things with it. Benita says, with high cost of living in San Francisco, younger people are moving away. I know some folks right out of school are all moving to New York City, but New York City is also pricey and the weather also is worse. But I think it's more diversified for industry than the San Francisco Bay Area. Melanie says, I've never understood why the EU startup scene just isn't as vigorous. You know, I had a talk, Melanie, with a business school professor. I was at the international conference for our accreditation provider, AACSB, in Vienna earlier this month. And then I rented a car and drove to Eastern Europe to see where my mother's family came from, which was great fun. But in that, I had a discussion with a British professor, and he's like, you enter a room in entrepreneurship and you want to discuss a business idea, and you'll get 15 reasons why this can't be done. Where then he comes to the United States, starts teaching a class in the United States about entrepreneurship, and people are like, here's how you can do it. Here's what you should do better. It becomes the question of possibility in the way that we think about things, which I thought was surprisingly inspirational and a story of hope when it regards to American snobbishness, foolishness, or whatever that we have going for us. Albert says, so it comes down to California being able to build housing. Yes. Homestead exemption. Yes, homestead. Beautiful time to move to Stockton. Aaron says, Texas ecosystem for tech is really a version that works for the industries in the TOLA region. Yes, agglomeration effects has 52 Fortune 500, Global 500. Exactly. Scott says, in 2021, Madison-based Fetch Rewards achieved unicorn status. Wow. Good job, Wisconsin. Very nice to see. Startups valued at $1 billion. How is the entrepreneurial infrastructure in Wisconsin these days, Scott? How's it going? Are things happening in Milwaukee? Are they happening in Green Bay? Are they happening in Oshkosh? It might be. So anyway, valuations are high. In the most frequent positions. All right, people, this is my inspirational slide for those of you in the Albert's List audience. That's right. The draft in Green Bay was very well attended. I saw the news on that, Scott. That was great. The 10 most frequent positions of future unicorn founders by specialization. Check your Rolodex, people. Where are you in this? Are you a scientist? 24%. Are you a CEO already? 22%. I guess that makes sense. What was your job? What was your first job? CEO. Engineer, software engineer, product manager, developer. And even then, Vanita, not necessarily. 6% of all startups are marketers. So there's hope, even for marketers. Rachel says exactly. Let me just apply for CEO right away then. That's what my students do. Be right or be wrong, but be confident. That's what this is about. Scott, that's a great link. Look at that draft. That is amazing. That is an enthusiastic place. 250,000 people attended the announcement, but the total attendance ended up at 600,000. That's insane. So obviously, and then whatever you do for your startup, advertise it at the Green Bay at the Packers draft. All right, that's good to start. Now, if you're interested in the healthcare industry, what do we got going? What's happening in hospitals? What's going on? Got a question specifically around this. So what are the places that are hiring in healthcare in the next year? I looked at a bunch of different forecasts. These came up entirely: healthcare IT, billing optimization, telehealth management, and patient engagement tech. If I were to boil this down into one spiel, if you can't heal patients directly, learn how to heal their paperwork, because that's where we're seeing a lot of the healthcare demand in the last couple of years, or it's expected to be in the next year, I suspect as well, based on what we've been reading. So looking at California hospitals in general, one aspect to note that we've seen in the industry in the Bay Area is the consolidation among major players. That's happened in a lot of large metropolitan areas, has reduced choice. Hospitals are interesting entities because while we operate in what's called a quote unquote free market, it doesn't really operate that way. And although we've had desires to make things like procedures where we've seen vast price differences ranging from a study that happened in the Twin Cities about 10 years ago, looking at the price of a very routine hip replacement surgery, ranged for out-of-pocket providers between $10,000 and $100,000 between hospitals in the same city. Most people don't know precisely what they'll be charged, and the complex array of networks and other issues prevents really a free market from taking hold and allows for a lot of rent-seeking price increases across the board in a lot of different respects, particularly in the healthcare industry. And so, but patient revenues adjusted per days have been more or less level since the fourth quarter in 23, but they are expected to rise 5% in a recent forecast in the next year. And this is a significant issue because we look at the income margin in California hospitals. The bottom percentile are losing money. About a third of hospitals are indeed losing money. The top 75th percentile are making about 15% profit margin a year, with the median falling slightly around 6% in the second quarter of 2024, which is the most recent quarter for which we have data. Vanita says, in removing waste and repetitive tasks in healthcare, hospital margins are pressured due to high labor costs, bam, downward reimbursements, inefficient process. So despite all the money we're spending, as Vanita points out, it's resulting in very, very surprisingly low profit margins for places like hospitals, which I want to highlight here. This has been an informal deep dive on the hospital industry in California. You can see, just as Vanita pointed out, it is despite the rising costs for individual patients, it is a complex industry full of incredibly high labor costs, much like, as it turns out, higher education after just coming out from a large budget meeting today. Melanie says rural hospitals rely on government money, so expect more closure. And that reduces choice, of course, for folks in rural regions in health outcomes, putting more pressure on that rural-urban divide and bringing more people and opportunities into the cities where there isn't any housing. Albert says, given that we may see huge cuts in Medicare, how will that affect the healthcare job market? Will we see a transition into private healthcare? Gosh, it's too early to tell. This is a really good question. So if you see huge cuts in Medicare, the healthcare job market will be affected for sure. Many procedures are run through Medicare in meaningful ways that would cause a significant adjustment for the healthcare industry, particularly if people hesitate to take on these procedures because of a lack of coverage, or if that coverage is transitioned into the private sector in an efficient way, you wouldn't expect to see much of a drop, but I have to see what the plan would be to transition out of that sort of insurance into a private sector insurance in that space. Vanita is our resident hospital expert. Vanita says that my California hospital had high-paying commercial PPO contracts and was losing dollars on Medicare. As I said, you don't remove inefficient processes, invest in AI and cybersecurity. You are toast. Bam. Good observation, Vanita. Colin says private healthcare wants to replace it with AI. That's true. My AI doctor always listens to me. Thank you, ChatGPT, for diagnosing my various conditions. Aaron says we need a major shift to beef up current urgent care centers across every 30,000 people, where you have one or two physicians led by PAs, nurses, and digital-driven health administration and use of smartphone apps for patients. Venus says most hospitals write off a lot of care for Medicare and Medicaid. So my guess is that the hospital industry would be for such a transition, and that means, bada boom, that means more chances on these other opportunities. And so I suspect perhaps they will celebrate it, but it will cause a transition of business models. It will affect many places. More health tech, said Vanita. More AI. Yeah, that's what we're talking about. More urgent cares. There we go. It's impossible to get seen, I feel, in so many places. New Mexico, in particular, we've seen a loss of physicians due to very high malpractice insurance costs. And so people have been fleeing the state, or we have for that reason. So we're trying to reform that with various bills that have come forward to encourage other physicians to remain here. Albert says, I'm just wondering where people even go for jobs now. It used to be healthcare and government. Now both are on the chopping block, along with nonprofits being impacted by less government funding and existing private sector struggles. I'm not really sure. I can tell people to stay in their current sector because at least they have the experience. So let's talk about the bond market. People are asking about bonds. What an adventure we've seen. I had a question about bonds on our docket. Looking at the 30-year and 10-year bonds after Trump's Liberation Day on tariffs, we saw the cost of debt in the United States for U.S. debt rise significantly. Why is that? So what are bonds precisely? When the government spends more money than it has, it issues bonds. And it spent more money than we've had over the last 30 years. And so bond prices and bond yields are two separate things that we have to look at. And so what the U.S. government does is when it needs to raise capital, it issues bonds. And the rate that pays on that debt depends on the market demand for those bonds. When a lot of people want U.S. government debt, the government gets away with charging a very, very low coupon rate or interest rate on that debt. So it says, thank you, Joe Schmo, for buying my debt. I'll give you 1% interest every year for 10 years for buying my debt. When nobody wants that debt, they have to give you more interest rate to entice investors to come in. And what this happened was after the tariff situation was people bet that, hey, wait a second, US government debt doesn't look as appealing as it did before, back to the dollar problem that we discussed earlier. And so to finance our 10 and 30-year debt, those treasury rates had to go up. We have to give people more interest to buy our debt now, which makes it more expensive for us to borrow money. And the 10-year bond in particular is unfortunate because what big consumer investment tracks the 10-year mortgages? So when the 10-year bond rate goes up, so do mortgage rates. And so we've seen, because of our Liberation Day on tariffs, an increasing 10-year rate, which is sending mortgage rates also higher. So Ajay says the only question is, Treasury notes are always part of your portfolio. Whether you invest in it or not, it depends on your risk and return projections. These are coupon rates, not prices. So these rates went up. But if you were holding debt with very, very low coupon rates, very, very low interest rates, that means you saw the price of that debt go down. That is the magic of finance. Rachel, even with healthcare jobs, patient experience roles are asking for medical licenses. Yikes. And to get into healthcare means more education. When in doubt, if you can't do anything in life, get a PhD in finance. That's what I always did. Aaron says the bond market is 100-0. They are the 90s bulls, undefeated. That's the spirit. Colin says, from where I'm sitting in the AI space, everyone should understand how management works in this industry. So when the lower skilled jobs are replaced by a fleet of AI workers, you can transition into a manager of AI agents role for the human element. Bam. Albert says, so our bond rates are right back to inauguration day. Bam, January 21st. So much progress lost overnight. Another issue that we've seen, we've had a question about the Fed lately. What if Trump fires Powell? He's since come out and said he can't or won't, but he is likely going to place any downward slide in the economy comfortably in the blame of Powell, even though it was not his fault. One thing to note, though, is that if we've studied central banks in general, they value their independence. Central banks are a banker's bank. They set the monetary policy for their countries that they represent. Here in the United States, our Federal Reserve has a dual mandate. They look for full employment and inflation of around 2%. Now, they're also reasonably independent. And countries that have the most independent Federal Reserves have the lowest long-term inflation. We still have the chair of the Fed is appointed by the president, and as a consequence, we still have some connection with the government, but there are more independent central banks like Germany and Austria, and less independent ones like Norway and New Zealand and Sweden, depending entirely on a lot of different political factors. But generally speaking, even among developed nations, central bank independence, the greater the independence, the lower the inflation is correlated, which is interesting. So breaking it down to the Bay Area in specific, on the left, you've got San Francisco. On the right, you've got San Jose. So in the March numbers that are just released, we don't have an unemployment rate out just yet. It is likely going to be similar to the February numbers of about 4.2% in both areas. We added in San Francisco, Oakland, Fremont, a stunning 1,300 non-farm jobs in that time period. Those of you who are farmers in San Francisco, congratulations for maintaining that rigorous employment. I'm sorry I'm not including you here. Farmers list, still part of the Alberts List family. And likewise in San Jose, they added about 300 jobs in that period. But where it depended on this, most area sectors, we've seen a continued drop, as Aaron pointed out, in trade, transportation, and utilities in both places. We've seen a drop in professional and business services in both places as well. In San Francisco, over 3,000 jobs lost. As a consequence, as we go down here and we look at the overall situation in the economy, things are more or less flat. We haven't seen a major downward revision, but a lot of fluctuation month on month. None of this looks particularly appealing. We did add approximately 400 jobs in information, but we're tracking 3% below last year's levels. And in San Jose, we're tracking 2% below after losing another 400 jobs in information. Still a rough time period. So now on this fantastic overview, as we go forward, what questions do you have and what questions did I forget to answer? And so let me readjust my screen size and then I will prepare for whatever you guys want to bring up next. Let me go up and redo this here. Keep changes. There we go. Boom goes the dynamite. Oh, a realistic depiction of the April jobs report. What is San Francisco without 10,000 Alberts?
because of
Ah,
the jobs.
no, that's right. This is Albert's list entirely. This is actually just for Albert's, actually. That's the joke about this list. It's always been that way. We just march to Albert's parade. Just strings, marionettes. Albert's list. Oh man, that's exciting. What do we got here in the chat window? That's fun. Colin, three things that are true at the same time. I love your points, Colin. AI agents can't fully replace humans. You should talk about this a little bit more. Can you riff on your points? Because I love them, because they're very important.
Yeah. Okay, so AJ, I think it was AJ. Yeah, AJ just posted a post where some people tested out a fully AI agent staffed company and did a little running test, and then the conclusion is that AI is not coming for your job anytime soon. And I say, um, uh, the experiment can be true, but it's not going to reflect the reality, which is cost of labor is an extremely high part of operational expenses for pretty much every single company, even tech companies. Where tech companies have, generally speaking, the highest margins for any industry, because software, once you write it once, you can deploy it, and the cost of reproducing that software is quite negligible. So the calculus as it's being run at the very high levels of, board meetings and C-levels directors, they're always going to talk about, well, how if we can't, like, at the end of the day, a company exists to make money, right? And a company only has two ways to really do that. Either you increase your revenue or you decrease your cost to operate. And generally speaking, it's way easier to reduce the cost to operate, which is why efficiency economics is such a huge thing. And then every single company looks at the line item of their cost of labor, which is what they pay people, and say, how do we cut that down, right? How do we make two people do the work of three people, or how do we offshore this job so someone in, China or India can do it at 10% the cost it would cost an American to do the job. And now that equation has been disrupted with the advent of AI agents. How can we have an AI do the job an Indian engineer or an Indian customer service caller would do? And that is a very interesting aspect. Um, so my earlier thing that I said, which is it's probably a good idea to learn how to manage in your industry and manage someone like you, is to say if you and everyone in your team was replaced by an AI agent, the company understands that at the end of the day, someone has to manage those AI agents. You can't remove the human element completely, but a team of 11 can be reduced to a team of one person managing 10 agents. And maybe this increases the margin of error. It re results in less productivity, but that little 20 to 30% loss is worth an 80% cost reduction from a mathematical and financial standpoint. And then from there on, they would scale that out a lot more. Uh, so the company is getting far more bang for the buck. And then that calculation is being discussed in by pretty much every company that approaches my company trying to replace their workers, and or any company who's trying to create an AI agent that is trying to sell to other B2B companies to replace their workers. And you know, I see this happening at the front lines. And it's definitely a little alarming to see that, hey, this is happening. And best advice I can give people is, I know it's happening. I know you feel like you can't be replaced, but that's not what the people who make decisions for you are thinking, because they desperately want to replace you. And I have no control over what they want. I just happen to participate in the industry. That's all. Let's see. A lot of chat. Da, 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 da. Rachel Murray, manufacturing idea is blue dress shirts, apparently. And Albert wants to say, when will we start seeing the impact of tariffs in the numbers? Dr. White, would you like to take that? Oh no. Oh no, he's dropped.
Oh,
Oh,
okay. So, all right.
oh, he's back.
He's on his phone.
Yes, sorry about that. I apparently my internet did conk out, so I apologize, everybody. Thank you for hanging on. I've been AI this whole time. It's been a it's been a complete joke. Thank you, Colin. I really did. I heard most of what you were saying until just the last 2 seconds. So my apologies. So that was great. Thank you, guys. I wasn't just
Yeah.
abandoning this out of disagreement. I fully believe Colin. Colin and I have been extending some back and forth data on some messages on AI regulation and stuff, which have been greatly inspirational for me looking at this question. So I've loved that. So that's been super cool.
Yeah, always happy to engage with you on that. Albert has a question. When will we start seeing the impact of tariffs in the numbers? Do you
Next
have
few
the
months, next
next
few
few
months
months?
in general. And again, think of it this way. Think like bananas, we can't replace overnight. That gets passed through. Those price increases with tariffs happen very quickly because a lot of manufacturers loaded up beforehand on untariffed goods before the tariffs came out on February 28th. That caused that big trade deficit. We expect that these inventories won't be depleted now for some months ahead of time. So we'll see what happens. So that's a good question. So a few months ahead. And I think there was another couple questions too. Verdict on Trump's first 100 days, it sucked. No, it's for economic purposes only. It was rough. Uncertainty is expensive and it raises the cost for everybody. That's all.
You're actively looking for a tech job. What are your chances given? Well, that depends on your resume, your experience, the industry you're looking for, and finally, the most important aspect is who you know. So network, network, network. Show up to Albert's events, network, network, network. Work on your resume, network, 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 and keep on applying and be good at interviews.
Yes, be good at interviews.
Be good at interviews.
I know.
It sucks that interviews happen to be the most limiting bottleneck, I think, for most people to get a job because you can have the perfect resume, but if you don't impress in the interview, the human nature
Right.
is as much as we say we want humans in a lot of things, the human nature is very fallible. And people will pass on ideal candidates just because something fell off for them or they just didn't like the way you dressed, even though it has no bearing on how well you'll do your job. So be good at interviews.
I spend as I say also in addition, I think Colin's absolutely right. I think you got to spend a little bit of time too. Interviews are good, try to reveal your preference. But really, even when you're sending out those offers, what distinguishes your resume from everybody else in that pile? Give me something interesting. Tell me your interests. What did you do? You were a chess champion. You love skiing. You did this. You're a professional bosun or something. I'm trying to figure out whatever makes you interesting from other people. Don't feel free to put a little section in there that tells me. And also make sure you tell a heck of a tale. I know cover letters are often overrated, and about half of hiring managers will say they don't read them. The other half weigh them heavily. And I say that in those cases, do spend time crafting what you are as a person in your cover letter. Do take time to be vulnerable where you can be vulnerable in a place that tells people who you really are as a human being. Really set yourselves apart from other people to show that you know you've been on a journey to get where you are and you know exactly who you are as a person and what you can do for that company when it comes to hiring time. So I think this advice in general is solid.
So outside of that job
Oh,
advice,
good.
will there be jobs to interview for and write cover letters to and resumes to in the next
Yes,
couple of months?
honey. AI management jobs, as Colin pointing out, they're just out the wazoo. So
Mm.
we've got Vikram saying, are we headed to a recession? I think there's still probably a 50%, maybe even greater odds that we'll hit there if we're not there. Thank you, Scott, as well. I'm looking at the notes too about Christmas cards. I believe that. Anyway, okay.
Yeah,
So here's what we've got,
mhm.
yeah. To your point, Albert, this is going to be interesting. There is going to be jobs in certain sectors and places. And even during a recession, people can still get jobs. There's still churn, people still hire, people still fall off, people still retire, those jobs get replaced. But the nature of those industries are flexible. And it is harder to be in a job market in a recession, undoubtedly, than it is in good times. But also note that, for instance, the tech sector itself is a bit of a canary in the coal mine. You are more reactive in general. You're earlier to see your downside risk, and you're also earlier to return that. So when the rest of the economy is deluged in a recession, you'll start seeing an impact of greater startup investment and other things. That usually happens in response to lower rates and other funding opportunities. And so don't lose hope yet. You're surviving this right now. You're actually more prepared than the average bear for whatever the economy is going to do next.
If China decides to
Yeah.
decouple from the West and become more independent as part of the tariff imposition, which seems to be happening based on recent news, how will this impact the U.S. economy? Are we going to get goods from Vietnam and India and Bangladesh
Well,
instead?
if we also didn't increase our tariffs across the board. So the issue is, so the China is very interesting. Our relationship with China in particular has been interesting. You look at the relationship of two men. They had a nice article in The Economist about looking at the differences between President Xi and Trump, and just the nature of what they've lived through. Xi is a hard man by nature, and Trump is a pretends to be a hard man at times. And so you look to what this becomes, and so yes, if China decides to decouple from the West and become more independent, I think China will be actually very good at aggressively pursuing trade interests that benefit China. I think in the absence of, it's going to fill the spaces where U.S. hegemony has left. And that will have an adverse impact on our trade policy. I think in the United States in general, it will impact the U.S. economy. We'll find other sources for goods in other areas, but it's hard to do that and convey that same political will and spirit if we continue to demonize every country as a trade adversary in this situation. So I think it's complex for the U.S. as a whole. So right now we're making a war on trade against the world, Albert, and that's going to be
Mhm.
how it shapes up is going to be insane to figure out. So
And it's being
that's going to be
reflected in
tricky.
election
Yeah.
results in Canada, and we'll probably see it in Australia later this week. So it's really
Uh,
fascinating to see how it shakes out and how it's drastically impacted political races too. Not to get political,
mhm.
just making an observation there.
Trade
Um,
wars are easy to win.
yeah, trade wars are easy to win, and
No,
we're gonna
we
bully.
all lose in trade wars.
We're
We
gonna
all
bully Jerome
lose.
Powell into lowering interest rates and see where that goes too. Goodness gracious! All right,
Oh,
well,
sunshine, rainbows, unicorns.
yeah,
Except the unicorns are all Texas unicorns now. But it's true. It's great. Man, what a fascinating story.
wow,
Gosh, thank
yeah,
you guys for coming
darn,
today. We're so grateful. Thank you for making it
yeah,
happen. Thanks, Aaron.
yep.
Thank
So
you
with
for
that
your
said,
presentation as always.
thank you all for coming today. We hope that your next month will be pleasant as far as the job search goes. Our next webinar is actually coming up fast and furious around this. It's May 20th. So feel free to RSVP. It's in the comments here. We'll be actually be back, and actually, now that you think about it, in 3 weeks, Dr. White. So maybe something
Yes.
will change drastically
Oof.
between now and then. We might get our first
Yes.
jobs report. We might get fallout from these
Maybe.
tariffs, and you'll hear it from me as we email you guys every single time one of these reports come out. And so until then, watch for the links, watch for the news, watch for commentary that we have in our community, and we'll keep you posted on where this job market goes. Um, so yeah, thank you all for coming. We will see you in 3 weeks' time, hopefully with better news. If not, at least it'll be a little bit entertaining. So we'll see you all soon, and good night.
Thanks, everybody. Thanks, Marcia. Thank you so much, everyone. Aaron, Michelle, Alexandra. Thank you, guys.
All right.
Thank you,
Melanie
everyone.
Elwords. Thank you so much, guys. Have a good rest of your week.
Bye.